Good afternoon, everybody. My name is Tom Dunn, and I'm the Director of Business Solutions at TCIA. I want to thank you all for joining us for the third in a series of webinars TCIA will be hosting on important issues for your business related to the coronavirus. We will have the next one on April 22nd, next Wednesday. It's going to be on insurance considerations, and it'll be at the same time, 12 p.m. Eastern Time. I am pleased to introduce our presenters today from Lazear Capital Partners out of Columbus, Ohio. We have Ned Gerholt, who is a director, and Mike Morosky, who is a partner at the firm. Also serving as a panelist today is Aidan O'Brien, who is the Advocacy and Standards Manager at TCIA. Once again, we're going to keep everybody muted except for the panelists to try to keep the background noise to a minimum. You will have time and the ability to ask questions during the presentation by clicking on the Q&A button and typing them in, and we'll try to get to as many as possible in a lot of time. Our goal is to get as much information out as possible. And just a reminder, we will be posting the presentation and recording of this webinar on tcia.org later today. So with that, I'll turn it over to Aidan to get things started.
Thanks, Tom. So, hey, everyone. As Tom said, my name is Aidan O'Brien. I'm TCIA's Advocacy and Standards Manager. And so a major part of this role is really coordinating the association's government relations and advocacy efforts. And this has really taken center stage and becoming really important in the past 6 weeks or so as the COVID-19 situation has developed. And so as we see it, a main part of this role is really to make sure our members have the most accurate and up-to-date information on what the government is doing and other programs are available that will help members' businesses get through these challenging times. And so for that reason, Tom Dunn and I have worked closely the past few weeks to put together these informational webinars for our members. And so if you missed it, we've had 2 webinars on the last 2 Wednesdays. The first was on new paid leave obligations under the Families First Coronavirus Relief Act. And the second one was on the CARES Act stimulus plan. That touched on Paycheck Protection Program, SBA disaster loans, and other important business considerations for tree care companies. So both these webinars can be found on the TCIA COVID-19 resource page, which is on tcia.org. So if you missed it or want to catch up on that, and I know our presenters will touch on those 2 topics today as well, these are some great resources that we highly recommend our members look through carefully. So as we move forward in this COVID-19 world, TCI wants to ensure our members are getting the most relevant and up-to-date information for their businesses. So if there's a topic you'd like us to cover a little bit more, or you want to know a little more about, feel free to reach out to us either in the chat on the webinar today or just reach out to any of us at tcia.org. So without further ado, I'd like to turn it over to Ned Gerholt, who can get us started on the presentation today.
Hi, everybody. Thank you for joining. And presumably everybody can see the PowerPoint presentation that we're sharing there. If for any reason you're unable to, maybe shoot Aidan a note there. But I assume what we're looking at is what you're able to see. So yeah, I want to get started. Obviously, one of the things that Tom had asked that we provide some help with is cash flow considerations, because obviously critically important in this time, given the uncertainty of not only what is the current state of business, but what it's looking like in the next few weeks. And honestly, nobody knows. If we all knew that this was over in 3 weeks, then this would be a little less critical and timely. But the uncertainty is creating obviously a lot of anxiety for business owners. So we're going to give you a couple strategies for how you should look at your cash flow. And then we're also going to touch on some other items. Let me go to the thing. We're going to, first we want to obviously talk on cash is king. You need to be able to preserve your cash as best as possible right now. And Mike's going to give a presentation and talk about some of those. What are some short-term options for you in terms of keeping solvency? What do you talk to about with your current bank? We're not going to spend too much time on it because I think at this point everybody is probably well-versed on the PPP and the Main Street lending program and all these other ideas, but obviously that can be a source of capital for the business. We're going to talk about some alternative strategies, some support investors that you depending on how long this goes, may need to consider. And then also tax breaks and incentives, because those are, as much as bringing in cash is important, sending out cash or delaying that is just as critically important. And taxes are obviously one of those outflows of cash. So a little bit about me and Mike. Mike is a partner at Lazear Capital Partners. Has been with the firm since 2003. I'm having him present with me here because not only is he our resident CPA expert, but he has significant experience in restructuring businesses in times of distress or in times of trouble. And, hopefully everybody's, moving along reasonably well here, and backlog is, doing what it, as best it can. But, having that experience is critical to understanding how to look forward in the next, we like to look at a 13-week window, which Mike will walk you through. Anything else on that, Mike?
Yeah. First off, thank you, Ned, for that introduction, and thank you, everyone, for the opportunity to speak with you and address you about these important topics. We, as Ned may have mentioned, have purposely tried to develop a relationship with the TCIA because we've had a number of clients in the industry and feel therefore an affinity for what you do and the role you play in society. So we appreciate the opportunity to be here. The one thing I'd like to add is, yes, I have been spent in a large part of my career as a turnaround and workout advisor, ranging from the CEO to chief restructuring officer of a number of different companies to merely an outside consultant. And because of my age, I'm 49, I've seen multiple downturns. The first big one was in 1997, which was referred to as the Asian financial crisis. The next big one was the Great Recession that we're all still familiar with in 08, 09. And then now we have the COVID, virus and outbreak, and almost inevitably recession that will occur. And I just wanted to draw the distinction because this is a source of optimism in my mind, that in the past, when my colleagues and I would see recessions occur, there was a lot of blame. People would look at companies and they would say, oh, well, this company's in trouble, this company's struggling, and it may be because of something they did. Maybe they had too much inventory, or they had too much staff, or they were, overextending themselves in one way, shape, or form with bank loans or capital expenditures or something like that. This time's a little bit different. It really is, in the sense that no one is laying blame so much, because the virus was not man-made, right? And no one's really at fault for this. And so there's a feeling of, hey, we're all in this together now. We are all suffering at the same time. Therefore, we should all do the best we can to help one another. So as you're going to see later in the presentation, we talk about that. Your bank, you shouldn't view as an entity out there who could be problematic for you, but rather an entity that could be used as a resource, a partner to help get you through this, or some of the government stimulus programs. So that I take a little bit of solace, a little bit of opportunity to, be optimistic here about that. But we'll get on and talk about that as appropriate.
Thanks, Mike. Yeah, and so a quick background on me. I've been with Lazear Capital for 5 years now, and I work primarily on the ESOP formation side of the business, and we'll talk you through a couple companies in the industry that we've done ESOPs for in a second. My background is in long-range financial planning and analysis for larger Fortune 500 companies. So a little bit about Lazear. We, as I mentioned already, provide largely a lot of our work is ESOP advisory, but also do advice on management buyouts, sell-side engagements, capital raising, recapitalizations, turnaround, et cetera. We're a boutique investment firm. We've got about 15 employees. We're located here in Columbus. We have office and an office in Detroit. And we have a very broad range of skill sets. As I mentioned, part of the reason I wanted Mike to join us on the call is that, he's our resident CPA and brings that experience to this conversation, which is most important. And, we're not offering accounting advice here. We're providing you with a range of options. And obviously, at the end of the day, you'll need to speak with your appropriate accounting advisor and banking advisor and legal as well, where appropriate, for the exact right prescription for your company if you choose to pursue some of these routes. As I mentioned, we've done a number of transactions over the years. Obviously, specific to this industry, up on the top left, you'll see Arborwell. Arborwell, for those not familiar, is a commercial tree care company in Hayward, California, with operations in Sacramento, Seattle, various parts of the overall Bay Area. And then Bandit. I'm presuming everybody on this call is most certainly familiar with Bandit in some way or another. We advised them on their ESOP, which closed last year, and they're now fully employee owned. Very exciting. And then the rest are various industries and companies across various industries that we've advised in the past. So with that, I want to turn it over. Mike's going to walk you through, cash is king and banking aspects. I'll come back in a little bit with a couple other sections. But Mike's goal here is to help you. What are the strategies you can employ today, moving forward, to make sure that you're preserving cash as best as possible? Mike.
Yeah, thanks, Ned. So this really marks the beginning of the presentation, so to speak. And this is the first topic we've chosen to include because it's of paramount importance in understanding your situation. And of course, the title, as Ned said, is Cash is King. And there's a reason why cash is king, because cash represents the lifeblood, literally, of your company. It's the oxygen that allows the company to breathe. And if you don't have proper cash flow, your company is in great peril. It could be a sign that you are headed for trouble. So the first thing you need to do is appreciate that and then understand your solvency. Solvency is a more technical term. It's actually a legal term, which means your company's ability to pay its obligations as they come due in the ordinary course of business. So when you look out at your company, you think out over the next 1 month, 2 months, 3 months, and you think about all the different bills you have to pay, whether it's payroll, whether it's rent, whether it's credit card bills, equipment purchases, it doesn't matter. Do you have the necessary cash to pay for that? To the extent you do, then that means you're solvent and you're healthy. To the extent you don't, it means you could potentially be insolvent. And we'll talk about that further, which means red flashing lights and sirens should be going off internally at your company. And you should be thinking proactively about how you can deal with that, okay? So in the slide here, we broke this down into 2 separate categories. Number 1, sources of cash, and number 2, uses of cash, okay? So when you think about the different sources of cash for your business, we can go down the list. The first is, hey, how much cash do you have in your bank accounts? You have a savings account, maybe you have CDs, maybe some investments or something that's liquid that you can turn into cash, and that's certainly a source of cash. The next area could be a undrawn bank loan. Many of the businesses on this phone call may have something called a line of credit or a revolving line of credit, which is simply like an open ability to call up the bank and say, hey, I need money, okay? And to the extent that you're not fully drawn on that, that's also a source of cash, okay? Two very, very important sources. And the reason why is they're both under your control and you can both tap them very quickly, and that's the key. The next, which we're going to go into more on the next slide, is collection of accounts receivable. Most of you, I'm imagining, provide your goods and your services on credit, meaning you go out to a client, you perform your services, then you send them an invoice for the work you did, and they have a period of time under which to pay you. That results in an accounts receivable. Most of you probably collect those accounts receivable in somewhere between 30, 60, maybe even 90 days. But that's a source of liquidity as well. And then of course there's the sale of inventory, which you may or may not do on credit. Maybe you can sell your inventory for cash, or maybe you have excess equipment or property or something like that that you can turn into cash. And then finally, to the extent the shareholders have the desire and the outside capital, they could put money in the business as well. Okay, that's can be a little more controversial, but that is also a source of capital. Conversely, you've got uses of cash. The first one, and potentially the most important, is payroll. Payroll usually gets paid every week, maybe sometimes every 2 weeks, or even twice a month. But the employees need their money. They need to pay for their families. They've got auto payments. They've got their rent. They've got grocery store bills. They need their money, and that, of course, should be at the top of your list of considerations on how to pay them. There's also associated taxes, payroll taxes, FICA, FUTA, SUTA, workers' compensation, depending on the state you're in. Ned's going to address this a little bit later, but I would like to highlight one important aspect of this, which is to the extent your business is collecting employee portion of these taxes, okay, you're supposed to remit these to the government. They're called trust fund taxes. Sales tax could be another example if you're in a state which requires you to charge sales tax. It's very important that you don't use this money when you have a shortfall instead of saving it and remitting it when it's due. I've seen many companies over the years get in trouble for not properly segregating these trust fund taxes and then remitting them on time because the law states that you have to do that. That's not your money. It's the government's money. And to the extent you do that and you can't pay it back, there's fines. And then there's also potentially jail time as well in severe cases. These trust fund taxes are non-dischargeable if you were to file bankruptcy. So critical thing. And one of the key aspects to take away from this presentation is do not play around with those taxes. And then there's also your vendors. There's critical vendors, there's non-critical vendors, which I'm going to address on the next slide, but it's important to consider who they are and when to pay those as well. And then there's utilities, there's overhead, there's rent, and there's also payment on bank loans and mortgages, which in this day and age, you may be able to gain some relief on, which is something that will address as well. You'll notice that I listed these almost from most important to, I don't want to say least important, but you should pay attention to that because sometimes you have to prioritize your expenses when your cash gets tight. So why don't we move on to the next slide, where I'm going to go a little bit in depth further here. So this slide is really broken into 3 different buckets, and it's still around this concept of cash is king and understanding your solvency, okay? The first is you need to know what's going on with your customers. The only way you can do that is communicate with them, right? That means picking up the phone. That means calling them. That means visiting them. That means talking about, hey, I notice you owe me X amount of dollars for 5 different invoices. When will you pay me that money? When can I have an expectation? And when you do this, I highly recommend that you take notes so you can refer back to what they told you, ideally in an email, after the call or the meeting, and say, hey, this is what we talked about. We talked about how you have 5 outstanding invoices with us and that your intention was to pay it over the next 5 weeks on these separate dates. So you're establishing expectations, right? And to the extent they don't meet those expectations, you have a stronger argument with them as to when they should pay you on these missed payments. You should also talk to them about their solvency and their ability to make payments, because to the extent they're not able to make payments, or you're getting that vibe that they're struggling as well, you may not want to continue doing work for them unless they pay you in advance, okay? So this goes back to communications, open communications. Conversely, if they owe you money and you're desperate for the money, you may want to offer them a discount for quick pay. So let's say they owe you $10,000. You're getting the sense that they owe a lot of people money and that they don't know who to pay first. Maybe you offer them a 10% discount if they pay you immediately, because it's worth it to you just to get the cash in the door. I would summarize this by saying the squeaky wheel gets the grease. I know that's an old saying and you may be laughing, but it's very, very true when it comes to collecting receivables, that if you are constantly calling them, and you don't have to be rude about it, but you're making a big deal out of it and you're treating them professionally and with respect, and you're taking notes around it, the likelihood of you going to the front of the line as opposed to being at the rear of the line in their prioritization goes up incrementally. Now, the second category here is your business cost structure. Every business is made up of variable costs and fixed costs, okay? Variable costs are simply those costs that you can adjust within your power. You have the control to adjust them down or up, as it may be. A good example of that might be your direct payroll, the people actually going out to the client site to do the work. To the extent you have less work because your customers don't want to bring you out, well, guess what? You can adjust your level of payroll. You can lay off people if you need to. You can ramp up, conversely, if you need to. Fixed costs are a little bit different. Those are costs that are not directly related to the volume of work you're doing. Examples might be rent, or fixed people who work in your office, accounting clerks, the controller, someone like that whose workload really isn't based off of how much work they're doing, or I should say their payments aren't based off of how much work they're doing, but rather the fact that you just need them there. So this is something to keep in mind. And the other thing I would say here as well is be proactive with cost adjustments. Don't wait until you have to. I understand that these are human beings we're talking about. I understand that in many cases you've worked with these people for a long time, maybe sometimes even decades, and you understand that they have children, they have parents to support and so forth, and you want to be as sympathetic to their plight as possible, but you also need to consider the greater good of the entire organization. So maybe by helping one person, that's great for that one person, but it puts in jeopardy of helping the remaining organization. And I'm not here to tell you how you should prioritize this, but I'm here to tell you that you should at least be contemplating this. These are tough decisions you have to make because we're in tough times. So please consider that and don't take that lightly. And then finally, vendors, okay? When you pay these vendors is largely under your control. If you can defer payments or set up a payment plan with the vendors and say, hey, listen, we owe you X amount of dollars right now. We understand this is due, but we need a payment plan. We've been working with you for 15 years now. Now's the time we need some flexibility from you. can we pay you what we owe you over 4 weeks, over 6 weeks, whatever it may be? You'd be surprised at how many of these people will, potentially show you leeway. And this goes back to what I was saying in the beginning of the conversation of everyone has a feeling as though we're all in this together, right? The banks that support them, the governments that's giving us small business loans, PPP loans, whatever it may be, it's designed to cushion these types of blows. But if you're not communicating with them and you're not having these conversations, then it's not an option for you. Also, I'd like you to consider who are your critical vendors versus your non-critical vendors. Critical vendors are the ones you can't do your business without keeping them going. These are the ones who are providing you maybe key support services or key inventory. For instance, if you have equipment, they're the ones providing you the fuel for the equipment, or they're the ones who are fixing it when it breaks down. Non-critical vendors might be like FedEx versus UPS. Let's say you've been doing all your shipping business with FedEx. Guess what? You can ship via UPS now, and FedEx isn't going to put you out of business. So making those tough decisions can help you, elongate your amount of time in which you're solvent. Landlords are critical vendors, but guess what? They should be able to work with you if you're in communication with them and you're open and you're honest. Many landlords, which Ned will probably talk about later when it's his turn to talk, are actively giving deferrals on their rent right now if you approach them. And the reason they're doing this is because the banks are working with them on their loan payments. So please communicate with them as well and see what options are available. Likewise, banks, we're hearing, are also working with their clients as well. Part of our job is to communicate with banks. We probably communicate with 24 banks in the course of any one given week, and we talk to them about these kind of issues. And almost across the board, they've been given leeway by the government to defer payments, okay? They're not going to forgive necessarily, but to defer payments up to 90 days, which could of course impact your cash flow, could be very helpful. Same goes with the health insurers. If you have health insurance premiums and you're in contact with your agent, you may be given some sort of deferral up to 90 days. All of this stuff adds up in its totality and can make a big difference in getting you through the short term. Ned, could we go to the next slide, please?
Well, there we go.
Okay. Now, this is a tool which you're looking at called a 13-week cash flow summary. Many of you have probably already seen this, and many of you have probably used this as a tool in the past when your cash flow gets tight. Usually when that happens, if you have a bank outstanding, the bank will even ask you to prepare this. And it's a very simple document. You do not need to be an accountant to prepare it, although it certainly would help. It's a cash basis statement that shows you when cash comes in as compared to when cash gets paid out. This has nothing to do with accrual accounting. For those of you who understand the difference, accrual accounting is when something is earned or when something is expended, not necessarily when the cash is paid or the cash is received. This is very, very simple document. So we're going to walk through it. The top half simply shows the next 13 weeks, and you can see the dates in the gray box at the top, the first week being May 4th, then going to May 11th, all the way over 13 weeks later to July 27th. And it's meant to capture 3 months worth of time. And the reason it's only 3 months worth of time is that most people would say the further you look out into time, the less likelihood you have of predicting this with any level of accuracy, okay? So most people tend to work on just 13 weeks of time. So the top half of that is concerned with the inflow of cash, the cash coming in the business, which you have available to pay your bills. So it starts with the cash on hand at each week. So in the beginning of the first week, you can see we assumed 55. And I'm going to say this is in terms of thousands of dollars, okay? So let's assume the company has $55,000 available in their bank account. Then they're looking and they're saying, well, we're going to do some cash sales for 100,000. Then we have collection on our accounts receivable that, according to the accounts receivable aging we do, are scheduled to be paid. And we've called the clients to gain assurance that they are actually going to be making these payments. And this goes back to making phone calls and not taking something for granted. And then between all of those sources, you know, cash on hand, cash sales, and collection of AR, we have total cash available of $1,255,000 to pay our bills. Then we look at the bills that are actually due. No insurance is due, but we need to pay a little bit of interest to different bank loans. We need to buy materials and supplies. We need to pay our monthly rent of $100,000. We have utilities, which we need to pay. We have wages, and we have any other miscellaneous costs, which total up to $975,000. And we also, unfortunately, that week have a loan principal payment due. So this takes into consideration bank debt. So you can see we just squeak by. We have $1.255 million available to pay our bills and $1.1175 in cash that we have to spend out, which means we end the week with $80,000 in the bank. We started with $55,000. We end the week with $80,000. Now, I'm not going to go through each week, but I hope you can get an idea that it just rolls forward week after week after week. And on the bottom line, you can see that cash is growing from the first week from 80,000 to 430,000, 605,000, 855,000. So for the next month or so, things are looking really good. But guess what? The following week, you have payroll, you have rent, you have another loan payment, and cash plummets again. And 3 weeks after that, it plummets to the point where unless you borrow money, and I put 130,000 in here, and you can see it highlighted in yellow, you're going to go negative. You're going to have negative cash. And that really is the point of this whole exercise, is to say, hey, listen, 7 weeks out, 8 weeks out, I'm going to go negative with my cash based upon my estimates here. I better be ready, willing and able to borrow from my bank, or the owners of the business better be ready, willing and able to inject some money in here, or we're going to have trouble. We're going to have some difficulties. So instead of getting caught flat-footed, we can see in advance when the problem weeks arrive. Okay, that's really the benefit of this cash flow summary that we're doing here. And this is a simple one. I've seen ones that are much bigger, take into consideration much more granular details, but this one is just, I think, at the right level for our analysis here. Ned, I'm going to pause for a second and ask you, do you think there's anything I missed here before we go on?
No, I think Aiden, are there any pressing questions related to this, or should we move forward? I know we're going to be tight on time today.
The only question we got is this something that can be done in accounting software, or is this something you sort of have to put together yourself?
It depends on your accounting package. A lot of times people just do in Excel. Like I've done these in Excel over and over and over again. And that's usually the easiest way to do it. And your bank may have an example. They may have a template. I'm sure if you Google this online, you can get a template. If you want to follow up with Ned, that's a possibility to get a template. So I would Google it. I'd start there and see what's available online. So moving along, the next slide are sources of capital. And the biggest source of capital is your existing bank, right? And the rule number one on the upper right-hand corner is a little counter intuitive. Most people want to go into what we call turtle mode. They stick their arms inside their shell, they stick their legs inside their shell, they stick their head inside their shell, thinking that if they ignore the problems, it's going to go away. And I would advise you strongly that's the exact opposite way you should be handling this. You should lean into this, you should embrace it, you should get your banker on the phone. Hopefully you have a close relationship with your banker. If you don't, you should be contacting your bank and you should be arranging a meeting with the bank, because this gets back to what we talked about earlier, which is the environment right now and the attitude right now is where banks want to help you. They have money that they've been given by the government to deploy to help you, but you got to be communicating with them. You have to have credibility, and that comes from transparency, that comes from disclosure, that comes from answering the questions openly and honestly, okay? No business is doing great right now. So being open and honest is the best thing you can do. So the first thing I'd say is, hey, who is your bank? Who's your loan officer? When's the last time you've had lunch with them, invited them for the business, given them an overview of how you're doing, asking them for their advice on how they can help you, right? I'd want to know the types of loans you have outstanding, if any. Do you have a line of credit? Do you have bank term loans? What is your existing collateral? A lot of times you may find yourself in a situation where you have excess collateral, meaning you could borrow more money from the bank if you sat down and talked to them about it. You might have additional equipment. You might have property that's unencumbered that you could mortgage up and use to borrow money from the bank. Do you have any recent appraisals of your assets? You might find out that, hey, my equipment is worth more than I thought it was. I have $1 million loan on the equipment when it's really worth $2 million or something like that. And most importantly, do you have any personal guarantees in place? Because the extent that you have a personal guarantee in place with this bank loan, that looks a little bit different than if you don't. That's almost akin to you putting money into the business, because if things go poorly, you're personally responsible for paying that back, okay? And then you need to understand the collectibility. So I've seen businesses where they have personal guarantees in place and they have a lot of money outstanding to the bank, but frankly, they're not collectible. They don't have any outside resources for whatever reasons. Guess what? That's more of the bank's issue than your issue. There's an old saying, you know, the more you owe the bank, that's a bigger problem for the bank than the less you owe the bank, and the more collateral you have. So you need to think this stuff through and really metabolize it, because it all factors into what you can do with your bank. Then you need to think about your banking relationship. Are you in default? There's two types of default. There's a payment default, which is like the name suggests. Have you been making your payments on time? Usually you have monthly or quarterly payments that are due. And have you been making those payments? Hopefully you have. That buys you credibility and leeway with the bank. What about covenant defaults? Many loans will have covenants, which are simply financial instruments, financial ratios designed to help the bank understand how healthy you are and how much cash flow you have available and how much collateral you have to support paying back the bank loan. And I've seen many companies that are not in payment default, but they are in covenant default. So to the extent you're in default in one over the other, you should be talking with your banker about how you could remedy that, okay? Are you in the bank's workout group? So in other words, that's the bad boy group of the bank. If you get into trouble and your existing banker is unequipped or overwhelmed, they'll send you to the workout group. The workout group looks at this a little more clinically, and they will try to rehabilitate you to figure out the best way to get you to pay back the loan. That's when they'll bring in a consultant potentially or an outside restructuring officer to help them. Frankly, we've served in those situations many, many times in the past. And we work with companies to return them to health and help them figure out the best way to handle their creditors. And it's always a balancing test without going too far in this. And I can talk about this for hours. Each company has multiple constituents to consider, right? They have the shareholders, they have the vendors, they have the employees, they have vendors who are creditors, they have secured creditors like the bank. And sometimes this is a zero-sum game because not everyone can be satisfied. So you're in a situation where you have to prefer one over the other. And this requires working this out and getting everyone comfortable. And to the extent you can come up with a good plan to buy time to do all this, that's a wonderful thing. Okay. And then finally, restructuring versus refinancing. If you're having issues in your payment default or covenant default with the loan, you may need to restructure your existing loan so that the cash flows, the expected cash flows of your bank line up and match up with the payment terms that you have going forward. If necessary, the bank might want you to, quote unquote, invite you, that's a nice way of saying kick you out of your bank, to go get a new bank. A lot of times you can do that, can find a new bank, or you'll find something called a hard money lender, which is not necessarily a bank, but they're a finance company, and they'll charge you a little bit more money, but they'll bear that risk and they'll take that loan on away from the bank. Using financial advisors like Lazear or whomever else you may know can be very, very helpful in helping you find the right lending sources or working out a better plan with your existing bank. So I think that's it from my slides for a while, Ned, and I think we're going to go into sources of capital with you.
Yeah, and I'll be quick on these. You know, it's just important. I would imagine that most people on the phone are already familiar with the Payroll Protection Program. And if they haven't already taken advantage of it and pursued it, then they are going to. Just note that there is, at least as of now, a window of availability that is closing at the end of June. So if you do pursue this, you need to do it by then. Not to say that they won't extend it. Everything is all very much in flux, but important to understand. Also available, every state in the United States is now been declared a disaster area. So technically every company on this phone call, assuming we're in the 50 continuous states here, is available, has the option to apply for an emergency economic injury disaster loan. These are, this is more of a short-term working capital loan. There is still some conflict of understanding. I should say there's still a bit of misunderstanding between the banks and the SBA about whether you can pursue both of these at the same time. Some have indicated that it's one or the other. Other people seem to believe you have the option for both. We don't have that answer yet because everything is still very much in flux. The Main Street Lending Program is rolling out right now. That was supposed to be for companies with 500 to 10,000 employees. And these are non-forgivable long-term loans, low interest. There is indication now that they will be also now be available to smaller companies down to one employee. Again, everything is evolving, and I wish I could give you like a definitive answer as to what is what right now. But you know, as I said at the start of the call, and I'll say now, and I'll probably say again before we wrap up, you know, the most important thing you can do is speak with your CPA and find out what's the best fit for your company. Because there are also some tax advantages, ways to save on money, payments, and we'll talk about that at the end. But some of those are lost if you take advantage or if you receive forgiveness of your PPP loan. So again, speak to your CPA. And then finally, there's an anticipated phase 4. Again, this is just in talking phase right now. with Congress. So who knows how long that could take if it happens. And it's split right now primarily between either an extension of the current programs, an increase in the amounts and extension of time, or they've also discussed a $1 to $2 trillion infrastructure program, which could, conceivably impact some of the people on this call. Obviously, this isn't necessarily construction that most of you are involved in, but it doesn't mean that there couldn't be some sort of work that would come out of that. Again, always changing. Even some of the PPP plans, which were finalized a week and a half ago, are changing now. One other thing I'd say is, depending on what bank you deal with, we have heard consistently across a number of our clients that generally speaking, the smaller the bank, the easier they're able to get their PPP loan. The larger the bank, the more difficult. It's anecdotal, it's not certain. So if some of you bank with Chase, it doesn't mean that they're not perfectly capable of doing this, but just keep that in mind. Something to consider. All right. And then Mike, you were going to talk about mezzanine or sort of other options about support capital, correct?
Yeah, sure. And I won't belabor this too much, but what you're seeing on the right-hand side is really a capital stack. That's what we refer to as how a business generally capitalize is its money. So the easiest way to think about this is if you envision your balance sheet. On the left side of your balance sheet, you have your assets. You have cash, you have receivables, you have inventory, you have property, plant, and equipment. On the right side of your balance sheet, you have all the different ways you're paying for or supporting those assets, okay? On the right-hand side at the very top, you have accounts payable, you have accrued liabilities, which are unsecured obligations. Then you have bank debt, and that's what we call senior bank debt there, which are loans you may get from your bank. Those are fully collateralized, which means they'll make a loan contingent upon the amount of collateral you have and the amount of cash flow you have to pay them back. Oftentimes, they're personally guaranteed. And then conversely, at the very bottom, you have equity. Equity is what the owners capitalize the business with initially when they're starting the company, and then over time with retained earnings. So every year, let's say they make a profit and they distribute out some of the money to pay taxes or for their lifestyle or whatever it is, but then they leave some money in the business. That's called retained earnings or equity. Now, when a company gets in a situation where it needs additional money and the senior lender isn't capable or doesn't have an appetite because there's not collateral to support it, they may not want to lend any more money, okay? Or if the business owners don't have the appetite to put in more equity in the business, they don't have that source of capital. So there's something in the middle. It's called mezzanine financing, kind of like the mezzanine floor in a movie theater or in an opera house or something like that. That's where it gets its name. It's not the top floor and it's not the top floor. It's also called subdebt. And it is debt financing, meaning it's borrowed money and it's shown as debt on the financial statements, but it is by and large unsecured. There's no collateral to backstop it. There's no collateral to support it. It's not personally guaranteed typically. And there's a payment expectation feature on it, like it's all supposed to be paid back in 5 years, 7 years, or whatever. It usually is not amortized, meaning you don't have to pay, a certain portion of it each year. The mezzanine lenders do typically like a current amount of interest paid. And then they take something called a warrant or a stock option in the business. So to the extent that the business is doing well, they get a little bit of a kicker. They get a little bit of an extra incentive in order to make this loan and take the risk that they're taking. Mezzanine financing could be a very attractive option for many of the business owners on the phone here, because you're not giving up ownership by and large of the business. You're not deferring control over the business to a third party, maybe a little bit. Maybe they want a seat on the board or something like that, but they're not here to take over your company. And there are plenty of mezzanine lenders out in the country looking for good opportunities. Ned, if we could go to the next page, I just want to talk about that too. The challenge, though, is mezzanine lenders typically raise money and they can only lend that money up to a certain level, meaning the smallest loan I've ever seen under a mezz loan is really about $5 million. So if you're a smaller company and you need less than that, let's say you need $1 million, $2 million, I'm not so sure there's a mezzanine fund out there. It really starts at the very lowest in that 3 to 5 million, and then goes up from there, maybe 10 million, 15 million. I'm not sure if anyone on the phone would need that amount of money, but it is available. We are working with many different mezzanine lenders to help our clients around the country in the event they need additional support capital. And that's what it is. It's to support you through this period of time when cash flow may be tight. And the government alone and their programs aren't appropriate. The terms and conditions of their programs aren't appropriate to get you through this period of time. You may want to consider mezzanine debt. Now, one final point I'd make to you is firms like us, what we do is we go in there and ask you a series of questions, try to understand your business, work with you to project out your cash flow in the future, therefore your capital needs, to try to understand what's the most suitable for you and your situation. And then we introduce you to multiple sources so you can get the best deal possible, not just one source. So you run a little auction process to figure out who really wants to invest, what are the best terms you can get, how that works, and get you the most comfortable with it.
Okay, so I'm going to talk a little bit about the tax side, and obviously we talked earlier. Cash outflow is as important as inflow. Again, we are not a CPA firm, so you'll need to speak with your CPA specifically. But some of the items that have crept up in the CARES Act, which was the official name of the PPP program and all the other options, is that there is an employee retention credit. And this is effective for a period from March 13th through December 31st. And it allows basically up to $10,000 per eligible employee retained. And you're able to reduce or eliminate Social Security taxes collected for that person. So this is, rather than, what Mike was talking about earlier, the importance of remitting what you owe to the government, especially if it's not your money, critically important. The government is forgiving some of that. However, again, and I touched on this earlier, the employer, note the thing there at the bottom on the left, the employer is not eligible for retention credit if debt is forgiven under a payroll protection program. So if you're not taking advantage of the payroll protection program, make sure that you're at least taking advantage of the payroll credit that you're eligible for. Very important. Can obviously save a lot of money. And there's a little bit of good. By the way, the next couple slides have a lot of words on them. I'm not going to go through every word. I know we're tight on time. Mike and I have a little availability to stay on longer if needed for question and answer. Obviously, the goal is to get through 18 slides in a half an hour and then a half-hour Q&A, but that's always darn near impossible. So. But I encourage you to download and review the presentation for some more specific questions, and again, speak to your CPA. One thing that is buried in here, and you're all going to have to be made aware of, is that there is an Emergency Sick Leave and Family Medical Leave Act mandatory for companies under 500 employees. And I know this is one of the concerns that Congress had, is that in some ways this can be incentivizing people to not work, to take off time, because they are allowed, funds during their time off. They're allowed to be there. They continue to receive their pay during that time off. But I encourage you to review this slide and look at the two different acts. And it sounds like from what Tom said earlier, I think this was already covered in another webinar. So it's possible that the previous webinar has more detail than even this slide. But just be made aware that you have obligations as an employer to allow flexibility for your employees, either for their own direct care, or in the case of Family Medical Leave Act, for the care of others. So this could be a child out of school, this could be an ailing parent or a relative, a lot of flexibility. And then finally, we want to talk on some of the other things that have been buried into this CARES Act that can actually help you significantly, and in some ways could provide a cash infusion into the business that you may not have otherwise been made aware of. For companies that had a net operating loss, there's generally been a rule about how far forward you can carry those losses and how much you can deduct those net operating losses going forward. What the CARES Act has done is gone and opened up a carryback period for the years 2013 through 2017. So at any point, if you had a loss in the business, you're able to go back and apply those losses against gains from previous years. And what's really interesting about this is that you're able to then submit for a refund to the extent that you overpaid. Let's say you had a weak 2018, but a good 2017. You could apply some of those, let me clarify. You can apply current losses backwards to those profitable years and submit then for a refund. And so that could be a very useful infusion of cash into the business that otherwise wouldn't have been available. Again, obviously your accountant can guide you best on each situation. In the past, there have been limits on the amount of interest that you're able to deduct on your income taxes. That has been capped at 30% in the past. Beginning in 2019 and 20, they've increased that to 50. And then obviously, I'm sure you're all aware, especially for companies that are LLCs or S Corps, that filing date for federal income taxes have been pushed back from April into July. Who knows if there will be an additional extension beyond that. And then also on the 6.2% of Social Security, you are allowed to defer those payments in 2020. They don't go away, you still owe them, but you'll be able to pay them in a split between years 2021 and 2022. So again, 6.2% of payroll could be a significant number that could be very helpful in terms of delaying outflows of cash in the business right now. So we just wanted to touch on some of those strategies tax-wise that you need to be made aware of and want to pursue if at all possible. Highly encourage you to do that. Couple other things, and I think Tom at this point wanted to mention, Synchrony is a program that the TCIA operates with, and I'm going to turn it over to him to let him provide a little info here.
Yeah, thanks, Ned. And as Ned said, we can go over a little bit past 1 o'clock to try to answer some of your questions, but I thought I would at least mention briefly while we are discussing communication with your customers in cash flow, that TCIA has a consumer financing option through our Savings for Members program. Savings for Members offers discount programs on a number of business-to-business services you use every day, and one of them being the consumer financing program through Synchrony, which might help you with securing some jobs with your cash-strapped customers as we are hopefully coming out of this crisis. So just a reminder to check this out. and the other discount programs at Savings for Members. And you can access the program on the tcia.org homepage by clicking on the member discount program box. And so with that, I'll turn it over to Aiden, and we can try to get through some of the questions that you guys have.
Thanks, Tom. So we got a couple questions on the PPP funds and the emergency loans. So have those loans could you just clarify if those loans have been made available so far, or if there's sort of a timeline that we're expecting to see wide disbursement of those?
Yeah, so a couple of my previous clients have already received their funds. A couple that I spoke to have been approved and are just awaiting. The word I heard was that once it's approved through the bank and the SBA, then it's anywhere from 4 days to 2 weeks to get the money. And I don't know why one would be quicker than the other. There's no indication as to, other than if it's just a matter of processing speed. I mean, the SBA is being asked to lend out more money in 2 months than they lend out over the normal course of 2 years. So obviously there's a bandwidth issue. If your bank is an approved vendor for the SBA, then they're lucky in that they don't have to actually go to the SBA for approval. But yes, the funds are being made. And in fact, my understanding is that they've already approved 211, and I'm sure that number is old and past already. But I think as of a couple days ago, already 211 billion had been approved, with part of that funded. And as you probably know, the total size of the program is 350 billion. And right now there's an effort being made to extend that by another 250 billion to take it up to 600 million. No word on that. The Congress went on recess without approving that additional money. I guess they don't view this as an emergency.
So we got a question on the mezzanine lending, so I'm just going to read this. Could the mezzanine lending become more attractive if a small business wanted to expand, or perhaps create partnerships in state or out of state?
Yeah, mezzanine, that's exactly what mezzanine lending is intended to do, which is to provide that extra capital, but not necessarily give away equity of the business. And what I said before, I'll highlight again, is mezzanine lending only really starts at a certain size company, just because of the effort that a mezzanine lending fund would have to go through to place the loan. If you think about it from their perspective, they only have so much money, number one. Number two, they have to conduct diligence on the business. Number three, they have to really like the company's prospects, believe in the management team. And then, they have to actually hire the professionals to document the transaction and negotiate it. So it's not economical for a loan probably under $3 to $5 million. But if you've got a good story to tell and you've got a good growth prospect because of the money will enable good growth. That's really what it's for. And if you're interested in talking, we'd be happy to speak with you about that.
Great, thank you. So what's the best way to go about getting appraisals on various types of equipment from your bank or otherwise?
That's a good question, because if you just go out and hire your own appraiser and then hand it over to the bank, that's not always a good idea. I would first check with your bank to see who's on their approved list. Banks don't take appraisals from anybody for real estate or equipment or anything. So they will probably have an approved vendor list that they'd be willing to share. And then at that point, you would want to engage that appraiser to come out. And there are two types of appraisals. There's something called a desktop appraisal, which is where you would simply send them a list of your equipment. And based on, if you have a, 2004, F-350 heavy duty, they're just going to apply a flat number to it. Super Duty. They're going to apply a flat number to that and say, this is what we think it's worth. And then there's a more in-depth appraisal where they actually come out and inspect as much as is reasonable the equipment. So, if you have 15 bucket trucks and they look at 5, then they can apply, that number across the whole fleet. But I would talk to your bank first.
And Ned's exactly right. The only other thing I would add, though, is that whomever the bank refers you to, you want to make sure they have experience appraising tools and equipment in your industry. Otherwise, they may not really know what they're talking about and may not give you the best rates possible, the best values possible.
Yeah, I mean, you want to know that they have experience with stump grinders and chippers and chipper trucks and not just lightweight medium duty trucks and buckets.
Great. So it looks like we have one more question. So with the deferral of those certain taxes you mentioned, if we use a third-party company, are those type of options still available?
Are you saying like a third-party provider for payroll?
So I'm not sure. That's how I read it.
Read that
yes.
Read that one more time.
Yes.
So
yes, that's the question.
Okay, that is the question.
That's
okay.
what he's asking.
Yeah, there's no reason that you shouldn't be able to pursue the PPP and the other things. Now, if you're using a payroll provider, then I would probably speak. This is a good question. I hadn't contemplated this, so I'm just thinking off the top of my head here. But they should be more than familiar with these options in terms of deferral of like Social Security's, the 6.2 tax. I would speak to them first to make sure that they're either, I would just make sure that they're made aware of, if they're not already, the fact that you don't have to be paying these taxes until 2021 and 2022. It's a good question.
Well, I think that's probably a good point to end the session. Seeing that we don't have any other further questions, I want to thank everybody for participating, and just be sure to check out tcia.org, the COVID-19 page, for updates, and continue to stay safe, everybody.
Thank you, everybody.
Thank you.